Welcome, everyone. I'm usually a wanderer. I stand and wave my hands, but this session is being recorded, and so the speakers need to stay close to the microphone. So I'm going to sit and talk to you so I can use my hands. My name is Pat Wolf. I'm a new hire at the Maryland Farm Bureau. My purpose for joining the American Farm Bureau the Maryland Farm Bureau is to work on national policy issues and to work with the PAC, and front and center on the stage in Washington is the Farm Bill. Because believe it or not, talk is already taking place in Washington, D.C. on the contents and makeup of the 2023 Farm Bill. Now, as I think about the Farm Bill, I have to make a couple of points before we start, and that the Farm Bill is written and passed by an alliance of three interest groups. One, of course, is agriculture. The second is the conservation interests, and the third are the feeding programs, the food programs. And traditionally, those three groups have come together to write and generate the votes that are needed to pass the Farm Bill. If you look at the Farm Bill, 76% of funding goes to nutrition, 9% goes to crop insurance, 7% goes to commodity programs, and 7% to conservation. So farmers don't get the biggest chunk of change from the Farm Bill, but what we get is very important to us. The Maryland Farm Bureau will be forming a Farm Bill committee that will focus on what's important in the next Farm Bill. And this is the opening to that work. We know that there are 12, according to USDA, 12,300 farms in Maryland that farm over 2 million acres and add $2 billion to our economy. That makes us the #1 industry in the state. We also know that 650 million goes to conservation, to safety net programs, and to credit, and 15 million goes to farm loans in the state of Maryland. So the Farm Bill is very important to us. Prior to coming to the work for the Maryland Farm Bureau, I did work for the national organization, the American Farm Bureau, and I can tell you that the interests of the rest of the country do not match up with the interests of Maryland. And so the Farm Bill is one issue where you actually see different farmers from different states trying to outdo each other to get money for programs that are important to them. That's why we set up this program this morning, and our speaker this morning is going to give us the facts about what's important to Maryland when it comes to Farm Bill programs. So as I talk to farmers, everybody talks about the program that's most important to them. But for us to have an informed and effective voice in Washington, we need to understand collectively which farm programs are important to Maryland. So that's what we're going to be hearing about this morning. And I'm hoping that as we go through this, that you will think about ways, first of all, recognize the programs that are important to us. And then second of all, think about ways they can be changed to make them more valuable to our state. Because there's always a twist and a tweak that's needed to make them work better for us. So our speaker this morning is George Turner. He is the Eastern Shore Director for the USDA Farm Service Agency. And I asked him to provide me with a long and impressive bio, and he gave me 3 sentences. So I'm going to give you 3 sentences. And that is that he is our Eastern Shore Director. He has a 30-year career program working for USDA. He has a BS in General Agriculture from the University of Maryland, and he has a working knowledge of farming from growing up on a poultry and grain farm near Berlin. So he is going to, again, provide us a foundation for our Farm Bill work, our Farm Bill advocacy, by talking to us about Farm Bill programs here in Maryland. So you need to come over and either hold the mic or sit here so that the rest of the world who is watching us live can see us and hear us. So please take it away.
Thank you, Pat. Good morning. My name is George Turner. Just one correction, I'm 38 years. Yes, with the Farm Service Agency, and the precursor to that was the Agricultural Stabilization and Conservation Service. I started off in Worcester County in my home office as a county director, and then I did that for 14 years, and now 24 years as the district director. I think I've been through about 8 farm bills, and some of them still have that constant thread that goes through it, and basically that we're there to stabilize pricing in agriculture for farm producers. But as Pat mentioned, there's a lot more to the Farm Bill than just what Farm Service Agency or NRCS or RMA will take and add to the bill. What I wanted to do first, because I was telling Pat earlier that if I knew what the Farm Bill was going to be for 2023, I would probably be in Atlantic City right now. So the only thing that I would like to probably do in my presentation is to go back over what the current Farm Bill is doing. How does that impact Maryland, and what the benefits out of the current Farm Bill impacted Maryland from 2018 to our present day. We have one more year left on it, and our programs are pretty much in place for that. But I was going to take and sort of build that basis, because one thing that we do learn is that through history, that constant is still there somewhat to provide that safety net. So one of the things I wanted to talk to you about, of course, is the safety net programs that come out of the Farm Bill. Here we're trying to do, or what Congress is trying to do, is to put some type of safety net price support programs so they can provide you peace of mind, some type of way to manage risk and manage those ups and downs in those markets, because that's what that fluctuation is going to end up being. Another area we'll talk a little bit about is conservation programs. Conservation programs, they enable farmers to improve the water quality, reduce soil erosion, enhance wildlife habitat. And then the Farm Bill gradually increased in 2018, the national cap that we had, to 27 million by 2023. And there were 2 new pilot programs that came out of the current Farm Bill. And that was SHIP, that's Soil Health Improvement Program, and then CLEAR, which kind of hits home to Maryland a little bit, is one of the pilots. It's the Cleared Lakes, Estuaries, and Rivers pilot program. We have just had a sign up on that not too long ago, and it was titled Clear 30, where you would go into a CRP contract for 30 years for that. So that's looking at it long term. The other thing that we're talking about here would be disaster assistance programs are also a part of the 2018 Farm Bill. Those programs, they provide much needed support for agriculture producers to rehabilitate farmland, ranch land that's damaged by natural disasters. The Farm Bill continued funding those programs. A lot of the times, what happens with a program that gets started, there's a reauthorization of those types of programs in the next Farm Bill. And of course, farm loans. Farm loans provide access to credit to help start, improve, expand, and strengthen American farms. And I'll just put a parenthesis around it, even Maryland farms. The 2018 Farm Bill increased the amount that producers can borrow through direct and guaranteed loans, and made available changes such as microloans and emergency loans. Because of our time limit, I'm going to give us a sort of a broad perspective on some of the things without going into too many details. And I'm going to focus on some of those programs that are more apt to Maryland. When I looked at the Farm Bill, I went back and looked at the 2018 Farm Bill currently as it is. So I have one section here of some of the programs that are listed, and we look at that as manage. These are the types of programs that are there to help Maryland farmers manage their operations. So the first one, which is one of our most popular ones, is, of course, it deals with grain, or addresses grain, as the agricultural risk coverage and price loss coverage programs. Those are 2 different types of programs. They were basically reauthorized from the 2014 Farm Bill to protect farm revenue from changes in market conditions. It provides that safety net that we so often look for to be able to continue on when we are hit with price. And in this case here for ARC, ARC is the agriculture risk coverage one, production as well. And we'll talk a little bit more about that, where the price loss coverage program is primarily looking at price on a national basis. I have some, because our mission area is the farm production and conservation area. I also have listed here out of the Farm Bill, some of the NRCS programs and some of the RMA programs. Conservation Stewardship Program, Grassland Conservation Initiative. And then another one that hits home to us here in Maryland is the Dairy Margin Coverage Program, DMC. That particular program replaces the margin protection program from dairy from the 2014 Farm Bill. What it does is offers protection to dairy producers when the difference between the all milk price and the average feed cost, which is the margin, falls below a certain dollar amount, which is selected by the producer. Also in federal crop insurance, there was different insurance products that were offered up under RMA, under the 18 Farm Bill. And then one of our programs, again, the Farm Service Agency program, is the non-insured crop disaster program. That program picks up coverage on losses sustained by crops that are not covered under federal crop insurance. We have a list of very unique crops here in Maryland, believe it or not, that we have under NAP. Then I look at the other section of the Farm Bill where we talk about conserve. Opportunities here to implement conservation on your operation. Again, within our CS programs, we have the ACEP, the Agricultural Conservation Easement Program, the Agricultural Management Assistance Program, Conservation Innovation Grants. And then for Farm Service Agency, we implement the Conservation Reserve Program. And we'll talk a little bit more about that in a few moments, because that, again, is one of the main benefits for Maryland farmers. It protects soil, water quality, and habitat by removing highly erodible or environmentally sensitive land from agricultural production through long-term rental agreements. We also have the CRP Transition Incentives Program. Under that particular program, what we're encouraging there is landowners who sell or lease long-term to beginning or socially disadvantaged and veteran farmers and ranchers, and willing to implement sustainable practices or transition to organic production, providing 2 years of additional payments for expiring CRP enrolled land. And again, I'm sure you're going to have a lot of questions about some of the programs and the details of those programs. But once again, I'm going to try to give you a gloss over of what they are. As we talk a little bit later on, taking into consideration some of the components that go into those programs are probably what you're going to consider when you're trying to, within your committees, and see what it is that you want to promote into the next Farm Bill. Additionally, under NRCS, we have the Conservation Stewardship Program, EQIP, the Environmental Quality Incentives Program, the Healthy Forest Reserve Program, the Regional Conservation Partnership Program, and then Voluntary Public Access and Habitat Incentive Program. A lot of the programs there for conservation are there for continuing to protect and improve our quality for environment. Then we also have what I call recover as a portion of that Farm Bill. And these are opportunities to help your operation recover from any type of natural disaster. So these are our disaster programs. Again, some of these are very detailed and very specific, and have certain criteria upon which eligibility is based. We have ELAP, Emergency Assistance for Livestock, Honeybees, Farm Fished Program. This provides assistance when, again, producers of honeybees and fish are run into issues with the disease, including cattle, adverse weather conditions, blizzards, wildfires, and what have you. Emergency Conservation Program. We've utilized this in the past 3 years in Maryland. Typically, if there's flooding, is a good example over, I believe it was over in Frederick and Washington County. We implemented the Emergency Conservation Program. And what that does, it provides that technical assistance back to farmers so that they can, once again, recover from the natural disaster. The Emergency Forest Restoration Program, the emergency loans out of our farm loans section, Livestock Forage Disaster Program, Livestock Indemnity Program. If livestock are killed off in a natural disaster, that's where LIP would come in, the Livestock Indemnity Program. And then last we have there is the Tree Assistance Program, or TAP. Once again, based on adverse weather conditions, what we're trying to do there is to rehabilitate, in this case here, eligible trees for that particular program. And then finally, our funding program, which is basically our loans that we implement. The Biomass Crop Assistance Program, then down payment loans under our farm loan programs. We also have a farm operating loans. Those loans help producers pay for normal operating expenses, including machinery and equipment, seed, livestock feed. And we have direct loans up to $400,000 and a guaranteed type of loan up to $1.75 million in operating loans. Under farm ownership loans, these are those types of loans that help owner operators of family farms, as well as improve, expand the current operations. We have direct limitations up to $600,000 and guarantees up to $1.75. Those amounts had been raised under the 18 Farm Bill from the 14 Farm Bill. Farm storage facility loans. There, the agency provides low interest loans to build, purchase, or upgrade facilities and equipment used to store, handle, or transport those eligible commodities. Once again, we have a very good portfolio under farm storage facility loans. Marketing assistance loans, those are the types of loans when you need a little operating cash. And we all know that, prices for grain at the time of harvest are sort of at their lowest. So we take and we provide a 9-month non-recourse loan for that grain for marketing assistance loans. Under our farm loan programs, we have micro loans. We do those. Those are up to $50,000 and are less cumbersome than some of our other types of loans. The Organic Certification Cost Share Assistance Program. That was a new program that was introduced under the 2018 Farm Bill. And what we're looking for there is to provide cost share assistance to those folks who are trying to transition over to an organic crop. And then on an annual basis, that certification or that inspection that has to occur on an organic crop, we cost share up to 75% of that process. And then, of course, our youth loans. Typically, they're targeted for 4-H and our youth, in that it sort of gets them into what it's going to be like for the future for them as a farmer or as a livestock grower or producer. All right, so what I want to kind of transition to now, that's just a little bit of background, a little bit of base to start with for what we're doing or what we have under the 2018 Farm Bill. So what I wanted to go through next was to try and give you some idea on how the programs or the Farm Bill impacts Maryland itself, whether it's you as a producer or the economy for Maryland. So as we've always said, our programs are voluntary when it comes to participation. They are more conducive to areas based on this type of agriculture going on in that area. Frederick, Carroll County, and some of those other counties in that area, they're primarily dairy. The Eastern Shore, primarily grain. But there again, there's the variations of the programs that I've just went through that will hit every county in Maryland for that fact. What I'm going to show you next are the programs that are utilized, that financial impact and that it has. And then the data is from 2018 through 2021. And there are some of the program information that's been omitted. I call it other. So you won't really see some of the totals in that, but it is a part of the grand total of money that, or I should say benefits that have come to Maryland over the years. Some of these may be a little astounding to you. In 2018, Maryland, we put out to Maryland farmers $61,281,198. Okay, so that was a big impact there. Most of those were Farm Bill related programs. In 19, we had a few disaster assistance type programs that came into play. But in 2019, we dispersed to Maryland farmers $88,615,255. In 2020, we went further into some disaster assistance programs, as well as some of the pandemic related programs in 2020. Maryland put out to farmers $107,472,413 under our current farm bill. 2021, since we still have a few days left in December, there are still some additional wrap-up benefits that haven't been dispersed yet, but we've put out $99,948,035. So over the course of the 2018 Farm Bill, for those 4 years that we have, we've put out in Maryland to Maryland farmers and injected into the economy $357,316,901. And in addition to that, that does include some of the ad hoc program benefits. When I use the term ad hoc, those are those types of programs that are legislated by Congress. Sometimes it's because of a disaster event or something like that, or something that has hit agriculture and impacted agriculture substantially. Congress will then introduce a bill based on probably the constituents and groups like yourselves that will want to see how can we support agriculture continuously through that particular incident as well. The Farm Bill typically takes care of mostly our normal, if you want to call those normal, our sustainability programs as we go through that. So just as a graphic so that you can, I'm a picture person. I don't know about you all. I learned better that way. But these are the benefits to Maryland farmers from 2018 through 2021. Once again, our ad hoc programs, and I'll talk a little bit about those just to kind of give you some idea what that was, but it had a large impact, particularly for what we submitted or what we have put out in 2020 and now 2021. And then our safety net programs, which is our ARC and our PLC and our grain programs and our dairy programs, that took up about 23% of that grand total that I was giving you. 13% went towards those conservation programs. A minimal amount went to disaster assistance. And then our loan programs, which are basically, I did not include our loan portfolio for farm loan and for farm ownership and farm operating loans. These are primarily made up of our farm storage facility loans and our commodity loans as a part of that benefit. So, any questions so far? Okay, so let's just talk a little bit about, and the reason I'm going to go into some of these details now is to give you a base on which to work. We talk about it, we say, okay, well, what about that ARC-CO program? But I don't know that everybody really realizes what goes into the calculations and the determination of that. The ARC-CO program provides that income support tied to historical base acres. And it's not based on current production. And there are only a number of commodities, we call them covered commodities, that are program commodities. And I'll show you a list of those here in a moment. But those payments are issued when the actual county crop revenue of a covered commodity is less than the ARC-CO guarantee for the covered commodity. ARC-CO guarantee is determined by multiplying 86% of the ARC-CO benchmark revenue. Now, of course, you look at that and you say, well, that doesn't mean anything to me, right? So let me show you an example here. All right. Now, this is a little difficult to read. This is what I call our covered commodities. Okay. Primarily, I've highlighted what some of the primary crops there are in Maryland: wheat, barley, corn, grain, sorghum, and soybeans. This is the calculation that we go through to determine revenue. Okay, this is the revenue. And when I mentioned earlier about it being historical, now by the Farm Bill sets the effective reference price. So it's kind of like saying, and I'll take the example one there at the very top. Okay, so we have wheat. We have to go through the marketing year first. We're always paying 1 year after the marketing year, so we can determine what that value was during that market year on an average. These are the publishing dates for the final marketing year average price. And then we, like I said before, we have the effective reference price. What I have next is historical data. This is the revenue of what that actual revenue price would be for the years that have been identified. And we do what's called an Olympic average. We toss out the high, we toss out the low, and we then average the remaining three. So for in 2020, this is what we came up with. Our final 2020 ARC benchmark price is $5.50 for wheat. $5.50 for wheat. So then our projected or final payment, or excuse me, I should say our projected or our final marketing year average price was $5.05 for that time period. Now we compare that to what our national loan rate is, because we cannot exceed the maximum difference there at the 338. So what is it that you look at when you develop a farm bill? Okay. In this case here, a program that's supposed to serve as a safety net. So here we're looking at what is it that I'm going to be able to cover or manage my risk at under this program, you know, for the crop that I'm growing. So here we're talking about revenue. As I said earlier, ARC CO does also take into consideration production. Okay. Because we're in Dorchester County, and they've covered up my last part of the slide there. Anyway, this is the other side of it. This is how we determine the guarantee for what's going to be established for the ARC CO payout. How many of you got ARC CO payments this year? Do you remember? Okay. That's because the prices were much higher this year. ARC CO did not pay out as much as it did in the previous year, which would have been 2019. We paid out more payments. The example I was going to show you here was wheat. We have what's called HIP yields. These are irrigated production yields for the county. ARC CO focuses on the county itself. It does not focus nationwide. Okay. So when we're looking at these particular counties, in this case here, I identified Dorchester, the irrigated wheat, we paid $14 an acre on wheat from the 2020, based on the 2020 production and the revenue. So our guarantee is, again, over here. This is where the guarantee would be, but our screen is a little bit blocked for that. But once again, what is it that you consider when you're trying to, again, lobby for a particular farm bill? Is it price? Is it production? Is it location? One of the things that happened that Farm Bureau did in the 2018 Farm Bill was to lobby for a change in how that actual production comes up. And it was to make sure that we were using NAS prices, or excuse me, NAS production, whereas Farm Bureau lobbied for using RMA prices when it came to that. So that was one success out of that lobbying effort for that. And I'll say this right off the bat, because I work for the Farm Service Agency, I cannot promote or lobby for any particular change in programs or procedures for that. It's kind of like, here's the bill, administer it. So now I can try to explain it. That's for sure. So what had changed under the 2018 Farm Bill compared to the 2014 Farm Bill? These were just some of the things that I had added in for that. And I hope they didn't put the wrong. Here we go. Back up a little bit. Okay. So that was the ARC CO program. This here is the safety net program, or the comparison to it, where we only look at price. PLC is the current program. It's called price loss coverage. Here we're looking at it on a national level and not necessarily a county level. So PLC program payments are issued when the effective price of a covered commodity is less than the respective reference price for that commodity. The effective price equals the higher of the market year average or the national average loan rate for the covered commodity. There were some payments made under PLC this year. This is what we made for 2020 based on 2020 data. Remember, once again, I said, if we are doing, when we do the calculation, that is after the marketing year has been concluded. So this is the 2020 crop. Once again, wheat, barley, corn, grain, grain sorghum, and soybeans. The only payments that were made once we calculated that out were 45 cents on the soybean or on the wheat and 20 cents on the barley. Corn, grain, sorghum, and soybeans did not trigger because the actual marketing price was above what the effective reference price was, which means it exceeded, for example, 550 for the wheat and the 495 for the barley, or excuse me, it was less than 550 for the wheat and less than 495 for the barley. That's why there was a payment that triggered. But for the corn, grain, sorghum, and soybeans, 375 was for the corn, 395 was for the grain sorghum, and 840 was for the soybeans. So there you can tell that, you know, once again, based on the actual price, it did exceed the effective reference price for that. Let's take a quick look at the dairy margin coverage. This again is one of the more, if we had three particular programs that we are getting out of in Maryland or that we're benefiting from Maryland, is the ARC and the PLC program, the dairy margin program, and also the conservation reserve program. That's why I was focusing on those a little bit. However, like I said in some of the opening, was that there are far more programs than just that in Maryland that can be utilized. What we did for dairy margin is replace the margin protection program for dairy. What this program does, it provides dairy options with risk management coverage that will pay producers when the difference, the margin between the national price of milk and the average cost of feed falls below a certain level, and selected by the program participants. Under that, we have the coverage level in which a producer can choose to cover their dairy, their milk. For that, we have tier 1, which goes up to 5 million pounds, and then tier 2 goes over the 5 million pounds. There's a coverage level that's paid as a premium. If you recall, 2 years ago, the state of Maryland paid at the 950 that premium rate. They plan to do it again in 2022 program. The 2022 program has not been announced yet. We're hoping that it will be so by the end of December. The holdup there is the publishment of the interim rule that will add supplemental DMC into the equation as well. And also that what they're looking at is trying to redetermine that cost of feed calculation for that, as well as any other components that needed to be fine-tuned for that. So we're expecting that soon. And as soon as that's published, then you'll hear a national sign-up date established. And then at that time, the state of Maryland, I believe, will be taking care of or paying the premium at the 950 level for that. I mentioned the Conservation Reserve Program is one of our more beneficial programs that that we have in Maryland. Conservation Reserve Program, it contracts with agricultural producers so that environmentally sensitive agricultural land is not farmed or ranched, but instead is devoted to conservation benefits. This is a long-term program, either from 10 to 15 years, depending upon the practice in which is going to be installed for that. But we're looking here to control soil erosion, improve water quality, and develop wildlife habitat. In return, FSA provides participants with those rental payments and cost share assistance. And as I said, the contract can go from 10 to 15 years. We have several different types of CRP. We have general CRP, which is basically a bid process, continuous, and there's only typically a set aside or a certain time on which that general goes into effect. Continuous is pretty much through the program year. We also have the enhanced portion of the Conservation Reserve Program, where we have several state partners that go in with us and establish some of the more needed practices for that particular program. As I said, CLEAR is a pilot as well as SHIP, We only have one participant in the CLEAR program that was just done this recently this summer for a 30-year practice for that. Okay. That was the conservation section. The next one is talk a little bit about loan programs. Here, I'm going to point out to you the farm storage facility loans. They provide a low interest financing for producers who store, handle, and or transport eligible commodities they produce. This program is set up so that you can acquire, construct, or upgrade new or used portable, permanently affixed on-farm storage and handling facilities. We saw there was a need to, again, assist in the marketing of that particular commodity to provide a program that either provides some type of storage or some type of handling that goes along with it. Also, that's eligible under our program is the new or used storage and handling trucks, any portable or permanently affixed storage and handling equipment, as well as facilities that go along with it. Additionally, we have the marketing assistant loan program. When we look at marketing assisting loan, as I was telling you before about the storability, under those, it's a marketing tool in which, again, you can hold that commodity off of the market during its lowest period of time based on its storability, and then utilize it later on. But at the same time, you get the option of being able to have some type of cash flow. Typically, you harvest, you're harvesting and completed harvest, and you've got it in storage, but you want to prepay some bills before the end of the year. We've seen a lot of our producers take and use this as a marketing tool, put it under storage, get a loan amount for it, pay those bills, and then when they sell in the spring or later on, then they repay the loan. That's why we call it a non-recourse loan for that. But that's the marketing assistant loans. We do a good amount of business with those. We have some repeat people that utilize that. Also, under our farm loan program, we have regular farm loans. They offer direct and guaranteed loans to farmers and ranchers to promote, build, and sustain family farms for a thriving agricultural economy. Those ownership, operating, and emergency loans are available through our direct loan program. The ownership, operating, and conservation loans are available under our guaranteed loan program also. So there's two types. There's a direct loan program and a guaranteed loan program. But the goal of the farm loan programs is to help farmers and ranchers obtain commercial credit. Once the borrower is able to obtain credit from a commercial lender, our mission of providing temporary and supervised credit is pretty much complete for that. This is just a chart. It kind of gives you some idea what by program, what the maximum loan amount is, the rates and terms that go along with it, and then also what those proceeds for that, or what the use of those proceeds would be for. Just as an example, the direct farm ownership loan, the maximum loan amount is $600,000. The rates and terms, it's a direct FO rate less than 2% with a floor of 2.5%. If at least 50% of the loan amount provided by the other lender, terms up to 40 years, and then it's the same as a direct farm ownership loan. That would have been a guarantee for that. So. All right. When I showed you the chart earlier, I showed you about 55% of the funds that had come over the past 3 years were coming from ad hoc type programs. Okay, so most of you, you've been hearing about pandemic for goodness gracious, what, 2 years now? So this is what we have done at Farm Service Agency under some of the, we have what's called the Commodity Credit Corporation. The secretary has use of those funds as directed. And so we first started off with, everybody remember the trade agreements and how messed up they were? We had the MFP program. The market facilitation program, that was an ad hoc program that was included in our pie chart earlier. But since then, we've come along with the coronavirus food assistance program. We call it CFAP 1. It supported Americans, farmers, ranchers, and agriculture producers whose operations were impacted by the pandemic. And what we're talking about there, whether it's a processing or a transportation issue, or just basically no marketing for the crop or for the commodity. So we did that one. Well, they came along and reviewed last January the CFAP assistance again, and they expanded the original rule to include specialty crops and also contract growers. Well, here on the Eastern Shore, that was a godsend for some of our poultry producers. And also we had some for hog producers as well, some of our contract hog producers. So we just ended CFAP 2 not too long ago. But once again, a large amount of that benefit was for those producers. We also had the pandemic assistance for timber harvesters and haulers. Okay, that was a new one for us. We haven't really dealt much other than conservation in the forestry section. But those harvesters and haulers, because they were also, experiencing some difficult times with the harvesting of timber and the selling of timber. That's why a 2x4 costs what, $80 now? Anyway, our program provides financial relief to the timber harvester and the timber hauler. It did not provide anything to the sawmill or anything like that. This was the person who cut it off at the stump, and then the person who actually hauled it to the mill. That's where it ended. We also had the pandemic cover crop program, where it was shown that you as a producer, if you had crop insurance, you planted a cover crop prior to that, you were getting a break on your premium for the 2021 year. So. Okay. That was kind of the benefits of the programs that we had administered here in Maryland and what that impact was, and kind of give you some of the details so that you know kind of what you might be working with. What I want to go into now is some of the other portions that are a part of the Farm Bill. And I've just kind of labeled it payment eligibility. Okay. This is how a producer can become eligible, or some of the things, some of the criteria that are implemented or administered when payment eligibility comes into play for a program. So Congress and USDA have established requirements to ensure that farm program payments only go to farmers who are actively engaged in farming. Okay, that's a phrase that or a term that we use quite often. The 2018 Farm Bill extended the payment eligibility and payment limitation requirements for the 2019 through the 2023 program years. So what does actively engaged mean? So to be considered actively engaged in farming, a person or legal entity, which can consist of a partnership, a corporation, an LLC, an LLP, a trust, an estate, so on and so forth, they need to provide significant contributions to the farming operation. Okay, those contributions include capital, land, and or equipment, and active personal labor and active personal management. We call it the right and the left hand. You can't have just all the left hand, which is basically the capital and everything else, but not do some of the work as well. And so that's kind of what we're looking for there. So the active personal management contribution must be critical to the profitability of the farming operation. All contributions of the farming operation must be at risk of loss. In other words, you got to have a hand in the game to be able to meet the eligibility criteria for some of our programs. We have an exception to that. If it's a landowner and they're operating their own farm, then those contributions are going towards that. So, but keep this in mind when you decide to caucus on Farm Bill types of things, is that, eligibility is one of those things that is a part of the Farm Bill itself. How do you determine that? All of our programs have what we call payment limits. And, based on that eligibility is what that limit will be for that particular program, and how you get there. We call it attribution. Okay. If I'm a corporation, okay, the corporation may get the pay, but we attribute it to warm bodies within the corporation itself. So every warm body member of that corporation has to meet that actively engaged determination to be eligible, or for that corporation to be eligible for payments. Once again, we're tying everything back to, you kind of got to get your hands dirty to be eligible for some of the Farm Service Agency programs, or some of those USDA programs. Okay. Next. The other thing that I wanted to bring up under eligibility is we call it conservation compliance. And the only reason I bring it up is because it is a part of the Farm Bill, as part of the 1985 Con Act that was then reauthorized and reauthorized and reauthorized throughout our Farm Bill process. And it goes back that far. Conservation compliance requires producers to have a conservation plan approved by and on file with USDA if they plant annually tilled crops on highly erodible soils. This is dealing primarily with highly erodible soils. And it also prohibits producers from planting on converted wetlands or converting wetlands for crop production. I'll just put a little plug in here real quickly, and that is that we have run into quite a few cases where a producer may have leased land, cash rented some land, not knowing the history of the land, and it had been cleared by a previous owner or operator, and now they're finding out that it has wetlands on it and it's being farmed. Well, that makes them ineligible for program benefits. So be very cautious, if you're a cash rent farmer or you're purchasing a farm, to look at the history on that. Or if you decide that you have that plot of, the trees come out a little bit and you want to put in a central a pivot irrigation system, and you need for the irrigation to be able to go through there, check with your NRCS to make a determination on whether wetlands exist there or not. Farm Bill requires producers and any affiliated individuals or entities to comply with these provisions. As I was mentioning earlier about the corporation and the members, each member has to meet conservation compliance as well. But it will affect a number of programs, and one that we're really finding out a lot now because our farm storage facility loan program has increased. We have to do what's called an environmental, and I'll talk about that in just, I think it's the next slide actually, an environmental review as a part of that eligibility criteria. So anytime that the United States government invests or provides benefits, we have to comply with the environmental review or environmental laws for that funding. And the same thing would apply to you. So USDA's Farm Service Agency can assist you with a project, but we must conduct that environmental compliance review. It considers the environmental effects of any upcoming project and is required by the by NEPA and also the National Historic Preservation and also the Endangered Species Acts for that. Environmental reviews are required for all USDA program eligibility, including disaster assistance projects. I mentioned earlier about the ECP program. There it was an emergency program, but we had to take 60 days to determine the environmental impact of any of those programs to restore that land back. But those projects require an environmental review, and it might be any type of constructing or repairing farm related buildings, the infrastructure such as barns, digging wells, and particularly with conservation program or projects. So anytime that you as a producer, when you begin to disturb the soil below the plow level, is when we are really concerned about the environmental review on that. There are various stages of those environmental reviews, and we would suggest that you make sure that in your planning process that you consider that first for that. All right, now we've come to the end of the program where I can stop talking and you all can offer up any kind of discussion or questions that you may have for our topic. Yes, sir.
Is it set on Chicago market or
No, it's historical, but it will take into consideration. We used to use 5 markets. This would be under the PLC program. We would used to use 5 markets, which included Evansville, Indiana, Norfolk. Those were the ones that were closest to us. But that's kind of what we would be looking at for that national marketing average. The other is based on NASS data that comes in for pricing, and then a little bit of risk management agencies input as well.
Thank you very much. I hope you all have disconnected there. Is going. I know that I'm going to watch this 2 or 3 times because, again, I'll just say as we start into the next part of discussion, we appreciate what matters most in Maryland. And then, oops. No, I'm not. I won't be on the flow out there. As we move into the next Farm Bill, we need to appreciate what programs and what money is coming to Maryland. Number one, we have to argue that they be continued because there's no guarantee that these programs will be continued. And then second of all, we need to think about ways to improve them so that they will work better, be easier for Maryland Farm Bureau members, Maryland farmers to use. So thank you for coming to the workshop. Are you going to ask a question? Okay, go ahead, ask your question. I guess we should repeat the question so that it gets picked up. So go ahead.
So, as we all know, input prices are rapidly increasing with supply chain issues. Has there been any discussion from the USDA about any sort of assistance?
Okay, so the question is, we've been experiencing increases in input prices because of supply chain disruptions. And is there anything in that USDA is thinking to help with that situation?
Specifically to the Farm Bill itself, not as of yet. But I do know that I'm not sure exactly what's in these the current legislation that has been passed under ARPA, or what's coming out with the additional infrastructure legislation. There is some stuff that is in there that is dealing with some of those supply chain issues. But as far as like input prices, that's a tough one. I don't know how to answer that because I was reading this morning, AgWeb, okay, yep, what's fertilizer doing? Okay, and nitrogen. And some of it's going to be whether you can actually get it.
Right. So nitrogen's up roughly 400%.
Yes.
We obviously have tariffs, we have disruptions in the past. That was the premise of the market facilitation program. CPAP.
How quickly will anything that's in the pipeline moving through Congress hit the ground?
That's a good question. As anything that comes along, it requires a NOFA, which is a notification of funding availability that has to be published. The nation's newspaper is the Federal Register. And those interim rules and those notices of funding or those NOFAs have to be published first so that it can then, behind the scenes at the department, a lot of the infrastructure for that, for lack of a better term, the ins and outs of some of those policies have already been examined and looked at based on what the intent of the legislation was. So how long that'll take, I've been waiting for 3 months for the DMC, no, August, September, October, November. Yeah, about 3 months for the DMC interim rule to get published. So that's kind of where we are. And I would probably, hopefully guess by late spring anyway.
Are there any other questions?
Oh, thanks.
Okay, so yeah. So if I could sum that up, so everyone can know is that you've said that farmers who are experiencing spikes in prices should make sure that USDA and state agencies know, because there are factors in the calculations that can be adjusted to increase help. Does that sum it up? Okay. Okay, very good. Well, you will stay here for a few minutes if other people have questions. So and you're welcome to stay. However, lunch starts in 2 minutes. So we're going to wrap this up and if there's a sign up sheet, if everybody signed in that was here, great. Thank you. Okay. Thank you very much.